All right, let's get right into it. Welcome to this comprehensive explainer on the SAICA Code of Professional Conduct. Now, as your tutor, my goal today is absolutely straightforward, to get you exam ready by mastering Part 2 and Part 3 of the code. We are going to unpack the exact scenarios, the strict rules, and those fundamental principles that dictate exactly how professional accountants have to behave. And that applies whether you're working deep inside a corporation or operating externally as an independent auditor. Basically, think of this explainer as your masterclass for navigating the ethical minefields of the accounting profession. Let's dive in.
So here is our roadmap for today. We'll start with the framework for professional accountants, then move to accountants in business and their core duties, followed by business pressures and inducements. Then we pivot to public practice, looking at rules of engagement, and finally, managing client risks. It's a clear path splitting your potential career into two very distinct directions. But before we split our focus into those two distinct career paths, we really need to establish the baseline. Section 1, the framework for professional accountants, the foundation of ethics.
Okay, so sections 100 to 199 provide the foundation that applies to absolutely every professional accountant, no matter who signs your paycheck. The crucial point here? Your ultimate loyalty is not to your boss, and it's sure as heck not to your client's profit margins. The defining mark of the accountancy profession is its acceptance of the responsibility to act in the public interest. Whether you're an internal financial manager or an external auditor, your primary obligation is always to the fundamental principles of ethics: integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Keep this definition locked in your mind, because literally every single rule we discuss today stems from this core mandate.
Let's step inside the house for Section 2, accountants in business and their core duties. This is Part 2 of the code, which applies if you're employed as, say, a financial director, an internal audit manager, or a management accountant. You are inside the machinery of the company. Now, consider this real-world scenario. What happens when an audit manager, let's call him Manoj Ravji, is tempted to manipulate the annual financial statements of his company, RainTech, just to hit performance targets and secure a bigger bonus? This perfectly illustrates the ethical landmines of internal business pressures. Honestly, it's a classic exam scenario, the clash between personal gain and professional duty. So how does the code address Manoj's dilemma? Let's break it down section by section. First up, Manoj's desire for a bonus creates a direct Section 210 conflict of interest. He is literally forced to choose between his own wallet and his employer's right to accurate financial data. S210 is crystal clear. You cannot allow a conflict of interest to compromise your professional or business judgment. For your exams, remember this. You must take proactive steps to identify these conflicts early on based on your interests and relationships. But identifying the conflict, that's not enough. You have to apply safeguards. In Manoj's case, this might mean restructuring his duties so he doesn't calculate his own bonus metrics, or removing him from certain decision-making processes, or obtaining explicit consent from the board to proceed under really strict oversight. Now, if Manoj actually goes through with adjusting that revenue without supporting calculations, he explicitly breaches Section 220. This section demands absolute honesty and fairness in preparing and presenting financial information. You must use the relevant reporting frameworks like IFRS, represent facts accurately, and ensure you classify and record all information in a timely, proper manner. And here is a massive takeaway for you. Omitting information is just as unethical as inventing it. You can never, ever omit material facts with the intention of misleading investors or lenders. If you somehow find yourself associated with misleading info, the code requires you to take appropriate steps to disassociate from it immediately. This brilliantly brings us to Section 230, acting with sufficient expertise. Actually, imagine if Manoj was asked to do a complex valuation he's never done before, with a deadline of tomorrow. S230 reminds us that taking on a task without the necessary resources, time, or training completely threatens your professional competence and due care. You cannot intentionally mislead your employer about your skills. If you don't have the time or the expertise, your ethical obligation is simple: either get help or politely decline the duty. No exceptions. Still inside the house, let's look at Section 3, business pressures and inducements. We're navigating internal landmines here. Let's look at the external forces and toxic incentives that push accountants in business to break the very rules we just discussed. What actually makes a good accountant go bad? Well, it often starts with an inducement, which is covered in Section 250. An inducement is any object or action used to influence behavior. Think gifts, lavish hospitality, or even appeals to friendship. Under S250, you must never offer or accept an inducement if there is actual or even perceived intent to improperly influence behavior. Even if you think, hey, I won't be swayed by a vendor's expensive golf trip, you have to consider the reasonable and informed third-party test. How would it look to an objective outsider? If it looks like bribery, it's a breach. Next up, you must be highly alert to Sections 240 and Section 270. Toxic compensation structures and overbearing bosses are literally the leading causes of ethical breaches inside a business. Section 240 covers financial interests, exactly like Manoj's bonus linked to financial reporting. To safeguard against this, companies need independent remuneration committees and robust internal audit procedures. Then there is Section 270, pressure to breach fundamental principles. I was just following orders. Yeah, that is never a valid defense in the SAICA code. If a superior pressures you to manipulate results, you have to push back. And here is your golden exam tip. Always state that you will document the facts, the parties involved, and the specific courses of action you took when facing this pressure. Document, document, document.
So what happens when that pressure turns into actual illegal acts? This is Section 260 NOCLAR, or non-compliance with laws and regulations. As an accountant in business, when you spot NOCLAR, you cannot just look the other way. You must follow these exact steps. Step 1, obtain an understanding of the nature of the non-compliance. Step 2, apply relevant laws to understand how legislation applies to the breach. And Step 3, assess the potential consequences. Evaluate the harm to the organization, investors, or the wider public. Your job is to escalate this internally to management or the board to seek a resolution. Okay, now we've reached a crossroads in our explainer. We are transitioning from Part 2's internal environment, where threats revolve around bonuses, bosses, and data preparation, straight into Part 3. In Part 3, you're acting externally as an independent practitioner, like an external auditor or consultant. And as you'll see, the threats here shift entirely. You are now dealing with client fees, opinion shopping, and strict independence standards. So, welcome outside the house to Section 4, Public Practice and the Rules of Engagement. Here, the rules shift to focus heavily on managing multiple external clients and maintaining strict, unquestionable independence. You're no longer an employee of the company. You are the watchdog. Before you even begin the work, Sections 320 and 325 dictate the rules of professional appointments. You can't just accept any client who walks through the door with a checkbook. Under S320, you must rigorously vet potential clients for integrity issues that could threaten your own compliance with the fundamental principles. Plus, if you need to use an external expert, say an actuary, you must verify their reputation, expertise, and objectivity. And under S325, if you are serving as an engagement quality reviewer, you've got to maintain absolute objectivity. You definitely cannot review your own work or let familiarity with the audit partner cloud your judgment. This next breakdown shows your day-to-day engagement rules in public practice. Section 310 tackles conflicts of interest. It's like being asked to audit both Coca-Cola and Pepsi. You cannot advise competing clients simultaneously without explicit consent from both parties and rigorous safeguards, like using entirely separate engagement teams. Section 321 warns against the danger of blind second opinions. If a company comes to you asking for a second opinion on a tax issue, be very cautious. They might be opinion shopping and hiding the full facts that their existing accountant already has. Finally, Section 330 covers fees. Quoting dangerously low fees, a practice known as lowballing, creates a massive self-interest threat. Why? Because it threatens your ability to apply professional competence in due care, since you might be tempted to cut corners on the audit just to avoid losing money on the job. For our final section, Section 5, we're looking at public practice and managing client risks. This is all about safeguarding assets and independence. This is where professional accountants face the greatest regulatory scrutiny, handling client money and discovering illegal acts committed by the client. Let's quickly revisit inducements, but this time for public practice under Section 340. The general rule remains exactly the same: no gifts with intent to influence. If there's no malicious intent, you might use safeguards like registering the gift, reimbursing the cost, or donating it to charity. But, and this is a big but, when it comes to audit and assurance clients, the independent standards in Part 4 kick in and they are ruthlessly strict. You cannot accept any gifts or hospitality from an audit client unless the value is strictly trivial and inconsequential. Period. You are the independent auditor. Accepting a luxury watch from a CFO completely destroys the public's trust in your audit opinion. Moving on, Section 350 dictates the rules for holding client assets. The general rule? Just try to avoid it. But if you absolutely must hold client funds, you are treating them as a sacred trust. You must keep them legally compliant and entirely, strictly separate from your own firm's money. Commingling a client's funds with your firm's operational bank account is a massive breach. You must only use those assets for their intended purpose.
And you must be ready to account for every single cent of those assets and any income they generate at a moment's notice to authorized individuals. Finally, we reach Section 360, which covers NOCLAR for public practice. When an external auditor discovers non-compliance with laws and regulations, the escalation path is highly structured and far more severe than for an internal accountant. First, understand the matter. Second, discuss it with the client's management or board to give them a chance to rectify it. But step 3 is where the teeth really are. If management refuses to act, you must determine further action. You have to decide if the harm to the public interest is so great that you must withdraw from the engagement entirely, or even blow the whistle and disclose the illegal act to an external regulatory authority, which actually overrides your usual duty of confidentiality. So, as you prepare for your exams and step into your future career, I want you to ask yourself this final question. Whether you are inside the house, like Manaldravshi, facing the temptation of a quick bonus, or outside the house, managing a difficult, high-paying audit client, will you let pressure and self-interest derail your career, or will you let the fundamental principles guide you? Because the SAICA code, it isn't just a set of textbook theories to memorize. It is literally the armor that protects your professional reputation and ensures the public can trust our financial markets. Study hard, understand these principles deeply, and let the code be your compass. Good luck.